Welcome back. And we're moving into our first conversation for this morning, speaking about the economy. And we have with us this morning from Legacy Fund Limited, Economist Ervin Perez. Good morning and welcome.
Hi, good morning. Good morning, guys.
And we appreciate you being here to be able to demystify some of these very common terms that we hear when we talk about our economy. Yeah. Right?
So I think today we wanted to speak a little bit about GDP, gross domestic product.
Yes.
And a ratio, GDP to the debt ratio that we have, or the debt ratio to GDP that we see talked about in IMF reports, in whether we are in a position to be able to service our debt, etc. First thing we really wanted to talk about is what is this GDP, this gross domestic product. It's a number that is used, most widely used economic number throughout the world in terms of looking at different countries and how they're performing. First off, the GDP provides us kind of like a benchmark number of how the size of a country's economy.
Yeah.
So, you know, a small country may have a GDP, let's say Belize, of about, in a particular year, a little bit more than $3 billion. You look across north of us, Mexico, farther north, USA, you're talking about GDPs in the vicinity of $13 trillion. So just the size of the economy. So it gives you a sense of relative size. And also, an important element about GDP, it speaks about the value of all the goods and services, everything that's produced in a particular country in a particular period of time. So there's a time element, right? So how much goods and services are produced within, say, Belize, and it has to be within the jurisdiction. So location is everything. So whatever is produced in Belize, it doesn't matter if it's produced by a foreigner, or by a foreign company, or a resident company, or resident. If it's produced within Belize within this period of time, new goods and services, then its value is added into GDP. Yeah. So it gives you a number of, a kind of production number, an income number. We like to say that GDP is both an expenditure because of how it's computed, but it's also a reflection of income, because whatever is produced and there's a market value, so it's sold, somebody has received the payment for that. Yeah. There are certain things that are not recorded in GDP that we may, business transaction in a particular quarter. So for example, you buy a house from off the market, an old house. It won't be recorded in GDP. It has been recorded at some point before.
Because it's not new.
It's not new.
Yeah.
But you build a new home, right? Now that's recorded in this GDP if it's done within this quarter. Why? It's a new product. It's a new output for that particular period in time. So those are just some
yeah, the same thing with like used cars and like that.
The time frame that you refer to, would this be what we know as the fiscal year, within a fiscal year? A fiscal cycle, for that matter? So
it could be monthly, quarterly, and annually. In Belize, the Statistical Institute of Belize provides quarterly GDP numbers, and at the end of the year, they provide an annual figure. So the quarterly numbers are important to give a sense of how the country is going. And in Belize, the Statistical Institute of Belize provides, and we'll talk a little bit about that. If I could go to one of the slides, I think slide number 3, there's a component approach. So the GDP consists of activities in different sectors of your economy. And that approach includes what you call personal consumption, expenditure. So you and I, the individuals, consuming, would buy. Business investment, so business spending on new capital equipment, machinery, etc. You also have government expenditure, which is a huge part of our economy. So government buying new goods and services, new labor, goods, etc. And then, of course, we produce goods that we sell abroad, so the exports, and we consume goods that we import. So the net difference between your exports and your imports are part of your GDP figures. And so this is what we call, that should be G. This is what we call your component equation. Consumption, investment, government expenditure, and then the net, what you call net exports. So exports minus imports. Those numbers come together to produce your GDP totals, right, in a particular quarter. In Belize, SIB collects that data through a production number. Yeah. Then there's some other elements. If you could turn to the other slide, there's some other differentiation or types of what you call GDP.
Yeah.
One is what you call nominal GDP, and nominal gross domestic product is, as you say, it doesn't take the impact of inflation, right? So you take the market value of the goods produced, and that's what you end up with for this particular quarter. Now, because it does not factor in inflation, it could be inflated, meaning the numbers, when you're looking at GDP, you're trying to understand how much output the economy has in a particular quarter, how much income, real income was received. So besides the nominal GDP, you have what they call a real GDP, which is more important for comparative purposes. And if you go to the other slide, that real GDP, you might see from SIB, they call it GDP at constant prices. And what they have done, and what most statistical authorities throughout the world do, is they come up with what you call a base year. And from that year, this is the year that you factor all your prices from that year. How has price levels compare relative to that year? And the real GDP factor in what you call price inflation. So things have increased because of inflation. I put up a little table there for our audience to give a little explanation. So let's look at two periods, 2017 and 2007, and we're looking at chicken production. Small country and its unit of chickens, and so it's very simple. In 2007, the country produced 20,000 chickens. In 2017, they still produce 20,000 chickens. So there's been no increase in output. However, price levels over the period of time has changed. So in 2007, for one chicken, you'd get $5. In 2017, you have to pay $10. So if you do a GDP, like nominal GDP, where you multiply the number of chickens times its price level, in 2017, the market value of that output is $200,000. Yeah. Comparatively, in 2007, the market value of the output was just $100,000. So if you're just looking at nominal GDP, you may say, wow, this economy is doing so much better, right? Not really. Although the market value of output has gone up, there's been no change in real output, in real incomes. And that's the important element why there's a real GDP number. And that's the number that you really want to compare country to country. And Marlene, you mentioned this GDP per capita. It's usually looking at real GDP per capita, the real purchasing power of individuals. So the total output of an economy or income of an economy divided by its inhabitants gives you that GDP per capita, and is another measure to compare countries. Usually the higher GDP per capita, individuals may say our country is wealthier. But again, as we had mentioned earlier, while GDP is a good number to measure size of the economy and output, it does not measure welfare or distribution or income levels across a country. It just gives you a spot number.
And that was part of the discussion we were having. If you look at the GDP per capita and you recognize that perhaps what you are earning is nowhere close to that, it shows a bit of the disparity that does exist. While we don't, do we have data in terms of the income and the disparity within persons employed in the country?
So there is a Gini coefficient that is used internationally to look at distribution of income, and that kind of what you call the spread. So the tighter the distribution, the more the GDP per capita reflects what the average person earn. The broader that distribution, it goes away from that. So for example, our country, the last data we had, I think the GDP per capita in Belize dollars was somewhere about 9,000 dollars, so that's about 4,500 per capita in a year. Now you may earn substantially more than that, or you may earn substantially less than that. And how many individuals earn above that number, below that number is important, but the GDP does not provide that kind of information. So a lot of economists, when you're looking at economic welfare, will not look at GDP as a good measure to say how well the average person within a country is doing. You know?
What about fluctuations? I think it's one of the things I've learned in having multiple conversations or quarterly conversations with SIB is that certain fluctuations are expected. You know, we know when, let's say, we'll have more money coming in from the citrus industry or banana industry or lobster because that's seasonal. How does that or how is that factored in when looking at the GDP?
Excellent question, Marlene. And what I was just going to say is that, like we mentioned, you were asking in terms of the time frame.
Yeah.
So SIB provides quarterly GDP data. And in most countries as well, when you provide quarterly GDP data, you would look at this quarter's GDP relative to the previous quarter GDP to see the trend. Is the economy growing or is it shrinking? Locally in Belize, when we look at GDP quarterly data, we look at GDP for this period, this quarter, second quarter 2017 versus the previous year, second quarter 2016. And that, Marlene, is to try to take out those seasonalities, those fluctuations that take place because of how our economy has a lot of seasonality. The service industry, for example, the tourism sector is quite seasonal. And so what that would reflect during the peak of the season, the kind of economic activity during the peak of the tourism season versus the off-peak is tremendously different. So it's difficult to just compare quarter versus quarter. It's more logical to compare this quarter for this year with the next quarter for the previous year. So that's how you factor in those seasonality. Okay. The other thing people look at GDP for, and I'll switch to the other slide, is just the rate of growth. And that's an important element when we start thinking about debt levels, right? The rate of growth of your GDP. It is kind of a measure of how the wealth of your country is increasing, or the size of your economy is increasing. The idea being that if the GDP is growing very fast, the quality of life for the average person is going up because the per capita income in real terms, and I'm talking about real GDP growth, is increasing. But it's also important because when we look at the ratio, the debt to GDP ratio that we look at, the rate of economic growth relative to the rate of your debt growth tells you how this ratio is trending. Yeah. And so quickly, if we go to national debt, which is what we're interested in terms of relative to GDP, what's national debt? It's what we owe. The country owes as a whole, and it could be both what you call domestic creditors, meaning me and you, if we own some treasury notes from the government of Belize, the government owes us. We're domestic. If a foreign national outside the country holds that debt, then it's owed to a foreigner. Or if we owe debt to a foreign country, say Taiwan has been quite helpful, our Petro-Caribbean funds, that's foreign debt. So, but the total debt is national debt. And the national debt really is a reflection. So national debt is what you call in economics a stock variable, meaning it's a fixed in time. This is how much your country owes the world on the 15th of October 2017, right? But that's really a reflection of the economic practices of the country over time, because it's really a reflection of the accumulation of deficits. And if we talk about deficits from government side, really it's government revenues, which is taxes, right? And we'll come back to government revenues is taxes minus government expenditure, which is government consumption, right? If that is a surplus, then you're lowering your debt. But if you're running it as a deficit, then every year or every quarter when government taxes is less than its expenditure, it increases its national debt because it has to borrow to finance that deficit.
And in very layman terms, that means?
In very layman terms, this means that you're spending more than you're earning, right? So you have to borrow. Do that in a household, same thing, right? If your household income is less than what you spend on a monthly basis, you're going to have to put that thing on a credit card, or you're going to borrow from a bank, and so your debt goes up. So that's something for us to look at. And if we want to look at a table at the most recent number, and this is taken from the Central Bank monthly economic report as of July 2017, the level of domestic debt is $936 million, and foreign debt is 2.4. So approximately our total debt as of the 31st of July is $3.4 billion, thereabouts, and this is Belize dollars. And when we started to look at that debt to GDP level, so if we can go back to that table, just so that we can. So the domestic debt, our domestic debt to our total GDP is about 25.8%, and our our foreign debt to GDP is about 68.0%. So total, our debt to GDP right now is about 93.8%, and of course it has gone up. After the restructuring, it had come down a bit, about 84% debt to GDP, and so it's now trending back upwards.
Is this an indication of some of the economic challenges that we're facing as Belizeans at present? Because you keep hearing people talk about the cost of living being high.
Yes.
You keep hearing people talking about to borrow from a bank becomes a little bit more difficult because not enough money is being generated to repay loans, for instance, and all these other financial hurdles that one needs to cross, either from a personal household standpoint or from a national perspective. Does GDP, in a sense, speak to some of the challenges that we as Belizeans face?
Absolutely. One of the things that we spoke about very early is the growth in GDP. And over the last 6 or 7 years, we have been struggling to grow our economy. So GDP has been very slow. Actually, in 2016, there was a contraction in the economy. So when you have a contraction, two things happen. And when you look at those debt to GDP ratios, if we go to the other slide, two things happen. If your debt level is growing, one thing could happen if your debt to GDP ratio is growing. One thing can happen is that your GDP is growing slower, or is actually contracting because it's a denominator. It's at the bottom of the equation, so that balloons the numbers up. So when you do hear people say yes, things are more difficult, sometimes your debt to GDP ratio reflects that as it trends over time.
Can we get some clarification? Because I know one of the words that we throw about very frequently is that there is a recession. But in macroeconomics, there's a specific definition which is based on the measure of the GDP. Yes. Right?
So I have not heard the country of Belize or the SIB define what a recession would be, but in general terms, 3/4 of contraction in an economy is looked at as a recession. So it's a consecutive quarter. So, and when we look at the data, we have to be careful, like I said, because the country is so seasonal. So we have 2 quarterly information so far for this year, first quarter and second quarter. There actually was a slight contraction in the second quarter versus the first quarter of this year, decline, that is, in terms of output. That may be seasonal. Right? And so when you compare the same quarter, second quarter, versus the previous quarter, there was a mild growth in the production of about 1.1%, or $8 million. It's not large, so you will feel the effects of that in the sense that you're not seeing the economy grow. In our strategy for economic development, it specifies clearly that for individuals in the country to feel the impact of improving economics, the economy has to grow at least greater than 5%. So we're really below our potential, and you'll feel that effects in your house in terms of how the economy looks. And so this is a good slide here, because this is the question you're asking. So in terms of what happens to this debt to GDP ratio, increasing ratio, if you have an economic slowdown, your GDP is going slower, the ratio will balloon. Demographic changes, meaning if your population ages, tend to have more social expenditure on aging, and you have a smaller youth population, so productivity is less, and so that tends to balloon the debt to GDP ratio. Higher government spending. Why? Because government spends more than it's earning, then it continues to finance that through financing the deficit, so the debt increases. And the rate of change can be impacted by 2 things. One, if we can grow our economy faster, this debt to GDP ratio can fall, or the reverse, if the economy slows down, it balloons, right? So those are something. One thing we want to speak about, if we go to the other slide, these are some interesting tidbits. That to a great extent, the adequate debt to GDP ratio is, and we'll show some countries of interest, right, is arbitrary, right? In the sense that although the IMF and your creditors would want to say, you want to have a lower debt to GDP ratio, there is no economics that suggests that a high level of debt to GDP ratio slows down the economy, or vice versa. The causation is very weak. Sorry, what I mean is that there's not a lot of evidence. So a country could be highly indebted. So, and I gave some examples. These are all IMF data. So in 2015, this was the most recent IMF data on the collection, the debt to GDP ratio in the United States is 105%. So basically in the US, their debt to GDP ratio is higher than we are. Japan, 247% debt to GDP ratio. Germany, which is considered a stalwart of fiscal discipline, their debt to GDP ratio is about 71%. This is in 2015. Canada, also considered a well-managed economy, debt to GDP ratio is about 91, 92%. So you can see, and why I put this up there, two things. The your debt to GDP ratio could be high, but who holds your debt?
I was going to say that, yeah.
Is very important.
The major difference is they have higher domestic.
Exactly. Yeah. So the domestic in America, about 67% of the debt is held by Americans. So you owe yourself, kind of thing. 33% by foreigners. Japan is even more extreme. 95% of the Japanese debt is held by Japanese, and only 5% by foreigners. So that plays a big role because usually your debt is in your own local currency. Germany is similar, and Canada is similar. And what I wanted to point out is that usually your debt to GDP ratio speaks about your ability to repay, right? The higher it is, so looking at Japan, 247, that's like crazy. Can they even repay that? Yeah. But Japan has the lowest borrowing cost out of all of these countries. And we look at what you call their 10-year note. So the Japanese government issues a IOU for 10 years, and they pay less than 1%. That's 0 point. That's what you call 6 basis points. That's less than half of a percent, less than a quarter of a percent for a 10-year note. Our country, Belize, when the government issued a 10-year note, it's about 5% domestically. Even the United States, which has a lower debt to GDP ratio than Japan, pays more than the Japanese. They pay 2.2%. Germany pays less than the United States, pays about 40. So it's very arbitrary. However, I want to say something here. Belize is a small economy. These are large economies. Belize is a small economy, and so you want to always err on the side of prudence, right? We're also in that hurricane zone. You want to create certain safety nets, meaning you want to have certain buffers, which means for us, we would want definitely to have a lower debt to GDP ratio. And that's my personal economic perspective, meaning you want that number to be much lower so that you have, in the case of a natural disaster, the ability to borrow. And that will be based on how your creditors perceive risk. So while our debt to GDP ratio may be far below Japan, and Japan borrows just so cheaply, our creditors may see us still as more risky. And so we want to create enough buffers there to ensure that if we have a massive hurricane and we needed to go to the market to borrow either domestically or foreign, the space is there.
I think, how does it factor in that we have struggled with increasing the rate of growth of the GDP?
Structural. I think in our last conversation here, I said a lot of the challenges we have in our country is there's structural problems, meaning that you're not going to fix those. Structural means it's like, let's think about, you're trying to race, you're a racer, you like to race your car, right? But you have one of these old 1960 Beetle, and you're trying to do something like 100 and something. You're not, the car that you're in does not have the capacity to do what you want it to do. That's a challenge we have here. We have a lot of structural problems, both in the financial markets and also in our real sectors in terms of infrastructural weaknesses, ability to understand pricing in our financial markets, the ability to borrow cheaply, the ability to spread risks. And so unless we fix those things, it's always going to be a challenge for us to get our economy growing. Our hugest potential loss is our human resource, right? So we have so much of our young individuals not entering into tertiary school, not even getting out of second school. That's a huge loss in resources, which for small countries like us is tremendous. And if you don't fix those things, so your education system, so that you can produce individuals that can then produce stuff, you're going to grow your economy at 1%, at less than 1%, etc. So unless we can deal with the structural issues, we're going to continue to kind of like, chattel along, and our debt levels are not really going to change. Actually, it will get worse, right? Because if your economy is growing very slow or contracting, as you said, the debt levels balloon relative to that, because what happens? Government taxes is not enough to pay for all the demands, and so it borrows, right? To try to meet consumption needs. And so over the time, it adds up.
I think one of the things that we notice as well is the fact that whenever there is a situation where there is more being borrowed. I believe that taxes go up as well.
Yeah. So we always tell people that, you know, if government increases its borrowing, guarantee you that taxes will go up either in the medium to the long term, because what happens if you take on more debt, then you have to find a way to repay it.
Yeah.
And as usually you don't cut your consumption, right? You tend to try to borrow more. And so,
but then there's also this argument where some would say, well, instead of government having to borrow monies, just enforce tax collection and what have you, so that you're able to collect that desired sum of money internally, as opposed to having to look elsewhere for funding.
That's talking about tax efficiency. So how you can put in a tax, but then can you efficiently collect it cheaply, and therefore so the cost of collecting is cheaper. So yes, enforcement is definitely important, as opposed to just simply changing the tax levels to collect what you need. So that's definitely something to take a look at. I don't know the level of enforcement. You will hear from certain business people that the government is really starting to put pressure on enforcing and collecting on its taxes. But truly, what would happen, taxes collection is still very, it's an estimation of what you're going to get. Most individuals argue cutting expenditure gets you there faster, because you can say, I'm not going to spend, this ministry had $10 million last year, we're going to spend $8 million, I'm going to cut it by $2 million. You can see that effect right off. So, but what that does in terms of how it impacts the economy is also something to be concerned about.
Well, if you cut like welfare programs, then it makes more of a challenge. But if you cut what some people view as wastage when they talk about fuel consumption within the ministries, within government, then that's different. It's also where you make the savings that are important.
Are those cuts significant? And that's the question. Does the cuts in fuel savings for government, would that make a significant difference relative to, say, wage bill? So if you look at the IMF report, IMF is saying your wage bill, your public service wage bill is too high. Now, you know, that's very difficult to cut that because of the challenge with, you know, taking money from people or sending people home. So that's difficult. Just some interesting factoids. Sorry.
Go ahead.
I mean, we're always an optimist, as you say. I'm an entrepreneur. And so just wanted to point out, you know, remember I mentioned Germany is considered a stalwart of fiscal discipline in the world, in Europe. In 1934, though, 74% of the defaulted bonds in the US were German bonds. So it says, and German debt level was over 150% relative to their GDP. The country was bankrupt. Germany was insolvent as a country in 1934. And where they are now after World War II is insignificant. So it does say, with effort and discipline and hard work, any country can move themselves out of where they are, especially our country where we have so much natural resources, so much potential, so much space.
This is my opinion here, just looking at this particular example. 1934, the rise of Adolf Hitler, the Second World War, and post-World War II, it was essentially a rebuilding phase for Germany. Not only to reshape its economy and to develop the human capacity, but sort of rebranding itself to the rest of the world. To move away from that stigma that Germany was all Nazi and all this other stuff. So they essentially had a clean canvas upon which to draw a beautiful picture now. And I don't know that, for instance, in Belize, there is that vision and that drive. We don't have this kind of an event that brings about a sea change, but I don't know that we have that singular vision where one person, a leader, can enforce or introduce that kind of financial discipline, that fiscal discipline that you speak to.
Very good point, but let's think about it. Germany, after World War II, and they were seen as the cause for World War I, was considered a very militaristic country. After World War II, it was considered a very dangerous country, including what the people did in terms of the Holocaust, and not only just the war, but how they persecuted the Jews and everyone, and the amount of innocent people killed. So rebranding for them, I would argue, was much harder. But you pointed out why I said when Marlene asked us about the economy, why I said it's structural. The Germans made a structural change.
Yeah.
And that's what we have to do as a country. We have to take a look at structural changes to get you where you need to go. We have been saying, and I just wanted to congratulate the Poultry Association, that we're supposed to be the breadbasket of the Caribbean. We have the potential to do so. When are we going to do so? That's the question. And so those may be structural changes that needs to take place. It's happening in enclaves, in like, in the Mennonite community, where they're making the investment in their ability to produce and to produce for a global market and to compete in the region. We have to do that in all areas, not just in certain enclaves. But it's structural, and my point in bringing out this is just like what you said. Not only was the German economy devastated, because at the end of the war, and Japan, same case, economics were completely destroyed structurally by bombing, but psychologically they had to do a whole rethink, and that's something we may need to do.
A brand new approach.
A brand new approach.
Yeah. Now, I think in closing, when we looked at the numbers, and I think it was 93% debt to GDP. It's concerning if we look at it for just the concept of what we make and what we owe.
Yes.
But what are some of the areas that you think that we can be optimistic about at this point?
Good question. One is the potential the country has. I mean, as a country, in terms of land resources, in terms of, I mean, if you went to India, but if you went to another small Caribbean island, you'll notice that their ability to diversify their economy is very narrow, meaning that they may have land and sea, that's it.
Yeah.
And that's all they have. And so when the hurricane came and devastated a lot of these countries, that's put them back for years. Belize is one of the unique Caribbean, Central American countries that have such a diverse and potentially diverse economy. But I think one of the most important thing, Marlene, we have, and if you ever travel within the Caribbean and Central America, we have one of the most diverse ethnic groups, most diverse population. That diversity is a real strength because it brings a lot of different cultures, a lot of different perspectives. We need to start leveraging those things. Like I said, though, if you don't address some of the structural issues, so in education, it's a huge loss to a small economy that you're losing 50–60% of your potential, the most important potential. Not even the oil or the sea or the water or the land is better than the human potential. You're losing 60% of that right out of primary school. That cannot continue if you're expecting to move forward. So the potential is what we're optimistic about. We could be optimistic about what we can achieve if we put our heads to the grindstone, but we have to do the hard work. I mean, somebody might say your debt level is not that high. We missed well, let's not talk about the hurricane before we get to that.
The season isn't over yet.
Not yet, but so
a month and a half.
Yeah, we have to go.
Yeah. But, you mentioned something interesting, and we're quickly running out of time, but I don't want to miss the opportunity. Just, when you spoke about the loss of human resource or young people not completing high school or moving into tertiary level, one of the greatest concerns always is the amount of our budget that is attributed towards the education sector. And, where the idea of encouraging more people to stay in school or provide scholarships, because many people cannot afford to go to tertiary level, to achieve a tertiary level education, may actually increase that budget.
Exactly.
Is that, I mean, you talk about structural changes, we talk about cutting back on expenses.
But as you've mentioned, there are expenditures that you should consider investments, and there are expenditures that are consumption. You should cut on your consumption expenditure, but you should make more expenditure on investments. So an education is a tremendous investment that you make. The potential of an educated child versus a non-educated child is tremendously different. We cannot cut on making those kind of investments. In fact, I think the country needs to go to a point where almost it's mandatory to get through secondary school. It's mandatory to get through at least 2 years of college, because we're going into, guys, a new world where it's intellectual capital. It's all about knowledge, right? And you've been talking about AI, artificial intelligence now, doing a lot of the mundane, unskilled jobs. So if we want to be competitive, we really need to make that investment, Marlene, and it's time that we think, let's cut consumption. Fuel bill, right? use of fuel, use of cars. But let's put the money where we need to have it. And one of your news stories with a young 17-year-old tells us that, and the challenges that we're having with all of these young kids and within our community, we're not investing as a society enough in them, and they are our greatest potential. The fact that we're burying them every single day, we're burying a bunch of the young kids, tells us where our economy is, where our country is. So we need to put more investment in them.
That's a perfect summary.
Thank you so much. That's a great way to close off this segment. Thank you so much for being here and bringing all this information to us.
My pleasure.
All right. We're going to go ahead and take a break. When we come back, we'll be talking about the start of 16 days of activism. So stay tuned.